2024 will be the year of greater regulatory focus on protecting customers and building trust. The sector will have to place greater emphasis on continually improving their products and services and being able to evidence that through customer feedback. The rollout of the UK's new consumer duty rules is being watched carefully in other financial centres. The objective is to drive good outcomes for retail customers by setting clearer and higher standards of consumer protection. This requires firms to make financial products easier to understand and to demonstrate that they have not only acted in a way designed to deliver good customer outcomes, but can prove these goals have been met. This regulatory scrutiny has the potential to enhance consumer trust in an industry whose reputation was tarnished by the 2008 financial crisis. However, the first half of this year will create headaches for financial services firms as they refine products, processes, pricing, and build new data sets and embed oversight of this into their governance structures. We should not underestimate the challenges of implementing these changes and demonstrating fairness of existing products, as well as those that have already been sold, possibly years ago. The positives for customers are many, and this year we should expect to see customers being more directly involved in designing financial services products, the introduction of robust and systematic mechanisms to gauge levels of customer satisfaction, loyalty and trust, and the greater use of new technology to help firms make better decisions and protect their customers from harm. The adoption of quantum computing to crunch the mountains of data firms hold will enhance risk assessment, decision-making, and fraud detection. Two more big developments will have an impact in 2024, one short-term and the other long-term. The short-term outlook for interest rates appears to show a downward trajectory. This is generally regarded as good news for consumers and businesses who see the cost of money falling and would be expected to borrow more, thereby promoting economic growth. Many financial services firms have profited from a widening of their net interest margin as central bank base rates were frequently hiked to reduce inflation. With base rates now believed to have plateaued, it is likely that the margin will narrow in 2024 and 2025, with firms paying higher rates for savings and experiencing a reduction in lending margins. The longer-term development is the rise of central bank digital currencies. The idea behind these is that a digital dollar, euro or pound would offer the convenience benefits of commercial cryptocurrencies like Bitcoin, but without the volatility that can see their values fluctuate wildly, and central banks cannot go bust, unlike crypto exchanges. The worst-case scenario is that commercial banks again see their value chain deconstructed, as happened with new payments providers in the last decade. The more probable scenario is that they will remain connected with their customers and support central banks with the administration of these assets to minimize central bank overhead, and that they use crypto deposits as a source of funding as they do with traditional currency. We expect to see the accelerated adoption of central bank digital currency leading to standardized cross-border regulation. These common standards should reinvigorate cross-border trading, which would be welcome after a period of protectionism. While this may also increase the burden of compliance, in the longer term, international consistency is a good thing, as it will enhance the reliability of financial information available to clients, aid investment decision-making processes, lead to more rigorous risk management practices within financial firms. Ultimately, that leads to greater market stability and improves trust in the vitally important financial services sector.